What's going on, guys? In this video, we're going to talk all about footprint charts, all the way from the beginning basic stuff to the more advanced stuff at the end of the video, like the imbalances. All I ask you to do is please like and subscribe to me. It costs you absolutely nothing. It means the absolute world to me, guys. But without further ado, let's get right into it. Most of y'all are used to trading normal old candlesticks, right? Normal old candlesticks. Now, what a footprint chart candlestick is going to show you is the exact same thing as a regular old candlestick. If you already know what that is, obviously, if you watch the first section of the course, but it's going to show you the high, it's going to show you the low, it's going to show you the open, it's going to show you the close, but it's going to show you the in-depth offers. It's going to show you all the market orders that are hitting the bid, right? On the left side, the sellers, all the market orders that are listed the offer. We talked about these concepts, right? On the right side, these are the buyers. So it's going to show you the aggressive participants in the market and also plot these imbalances for you. To make it easier, it'll also give you the total volume per candle. So no matter what time frame you have it selected for, whether it's 15-minute, 30-minute, 2-minute, whatever it is, it's going to give you the exact volume per candlestick and also the delta. Now, the delta is a difference in market buy orders and market sell orders. So it's going to add it all for you and give you the exact delta per candle. So this candle had 1,600 more aggressive buyers than sellers. This candle had 1,400 more aggressive sellers than buyers because it is a negative candle. Now, also give you the point of control, which is this little yellow square you see in the candles. It's literally the level of the highest volume per candle, just like the volume profile. It's going to give you the point of control of every single candle, which is the highest volume point per candle. Now, something you can use this for, because the footprint chart will show you the exact volume, right? Volume per price point. So you'll see on every single candlestick, right, where most of the volume is sitting with the point of control. And this blue histogram is also showing you volume. So when volume thins out, right, that is what we use Bookmap for exhaustion, right? It's showing you exhaustion. So it's showing you underneath this level, volume died off and we see exhaustion. It can also show you absorption, right? Up here, we have 15,000 volume, 1,300 positive delta up here, but the market did not move up. So you can just automatically tell there's passive sellers absorbing all those offers. And the difference right here, right, we see 10,000 volume, negative 1,000 selling pressure, but the market moves down versus the market does not move up with these buyers right here. Closes pretty low. And we're going to just use this to read the market just like we did Bookmap, right? So we have the market opens right here, pumps up. We see exhaustion from a previous day liquidity level. The market then moves back down. Back at the open where we saw massive buyers, we see more buyers step in. As you can tell from the green right here, right? This is, again, just the offers that are hitting the ask, aggressive buyers. And the market then continues to go up. The only difference is now at this liquidity level, which is also a resistance level, we now see a lot of volume. So to break these levels, we need volume. So here we had exhaustion, we sold off. Here we had a lot of volume, we popped off, and we actually broke, right? So you can use this for so many things, man. So 8,000 positive delta, 8,000 buyers here did not move the market up, and then we see negative selling pressure move the market down. Same thing here. All these buyers did not move the market up, and the market continues to then fall down even lower. Volume dying out is just exhaustion, which you're going to use this as an entry trigger later on. You see exhaustion, especially if you see multiple candles with dead volume at a specific price level, it's showing you price does not want to be at this level. So it's a good level to hold, good level to put your stop loss, good level to get in long, right? And then we're going to talk about imbalances here in this section, guys. So you see aggressive follow through, especially if it's made of these imbalances, is a key scenario for us. So these are the settings on Quantower I have. So if you go on your footprint chart and you want to go ahead and click cluster settings, so you can kind of customize. I already have a full section of this course already covered-ish, but these are the settings I have. Make sure you have it selected and use my settings. Now, what is an imbalance? These are the squares I'm showing y'all, right? What is an imbalance? So it's a diagonal bid and ask imbalance. So if not, the imbalance is not in between the buyers and sellers. It's just between the sellers or just between the buyers, right? It's diagonal. So difference in the number of buy and sell orders. So when there's more aggressive buyers that lift the offer, right? They buy at the asking price. These are the aggressive buyers, right? Or aggressive sellers that hit the bid, right? They're sell at the bidding price, indicates that the market sentiment is leaning toward either buying or selling more strongly, right? It's built by volume traded on the bid and ask. So it's another volume indicator. You know, we use a lot of those. But it's an absence of balance between buyers and sellers, an imbalance. So an imbalance compares bid and ask diagonally and shows a significant excess of one over the other, right? So it compares between the level lower, not between each other. Right here you see 464, 464, 119. It's pretty similar. So why is it like this? It compares between the level lower, right? Not vertical, diagonal. So it compares bid and ask diagonally and shows a significant excess of one over the other. This is a bid compared with an ask, which is one level higher, as an ask compared with a bid, which is one level lower. And stacked imbalances happen all the time, right? These are just zones of consecutive, right, multiple imbalances that occur on the bid or ask side. These zones are important support resistance levels because they're levels where participants aggressively wanted to get into the market. So when market retests these levels, the same participants might appear again to protect that level or actually break through. So you'll see stacked imbalances like this all the time as well when you're looking at the footprint charts. But again, understand that they are an abnormality, right? They're a big offer, a big bid coming into the market, abnormality. And how you're going to use them, how we're going to show you how to use them is for the reaction. We're going to look for a surge in volume and abnormal delta. And for continuation, when you see these imbalances, let's say you're in a short and you see massive sell imbalances, that's good for you, right? They're entry levels to protect your risk, right? If you have a demand level and there's an imbalance right in demand, it's a great indication that that level is going to be held and adds extra confidence. Like let's say we break demand, make a sell imbalance and retest demand and that sell imbalance, is just an extra confidence for you to size up. And also as take profit. So the market tends to hold these levels, respect them. So it's a good idea to get out. Why we put our stop loss above them is also a good reason why we would get out of our profits at these imbalances. So what I mean by reaction. So imbalances are showing us abnormalities, right? But they, again, all are big players. So make an imbalance like that, you need a big participant. A lot of money is what that means, right? Multiple touches will show you support resistance levels made by the tape. So multiple imbalances being made or multiple touches on the imbalance without any kind of breakthrough shows you strong support resistance levels, not just based on candlesticks, but based off of order, that level 2 behind the scenes data. Continuation. So we're going to look for the creation of supply and demand zone, right? For supply, you want to see a sell sign imbalance, and demand, you want to see a buy sign imbalance. And also the volume and delta, an increase of volume, increase of delta following the imbalance. So this part, we're going to talk about how you can make your supply and demand zones even stronger. So we get an aggressive move. Demand was made. We get an aggressive move off to start the demand, and an imbalance is being made, right? So then you wait for price to retest that imbalance for extra confirmation to go long. It's very simple, right? My thesis is short. I will look for sell sign imbalances off supply. So it's the exact opposite. So let's say supply was made here, right? We get a sell imbalance made by an aggressive move. This is gold right now, so you can tell volume is low, but 52 out of 300 is hard. So we want volume to pick up on the move, and we want the delta to pick up on the negative side. So this is how you can make your supply and demand zones even stronger. Then we retest these imbalances for our entry. Very valid and very strong. Now again, I have multiple things I look for. This is one of them. So what to look for in these imbalances. So the imbalances are showing us price level where there has been an abnormal amount of one-sided activities. For longs, I want to see volume die off at the imbalance, right? Or aggressive buyer prints start coming in. So if I'm looking for a long off a buy imbalance, I want to see volume die off as we're approaching the buy imbalance, and I know it won't break, right? Or I want to see aggressive buyers start to step up at the imbalance, so I know the continuation will happen. So for shorts, is the exact opposite. I'm never going to go against the imbalance. I'm never going to short into an imbalance. There's a good trade it might bounce, good chance it might bounce. I'll rather just wait on the break of the imbalance, so I know I'll be in the clear. Also as perfect take profit levels. So if I'm in short right here, we have a sell imbalance coming in, right? We get a retest of that imbalance and we start to sell off, and my take profit will be at the imbalance. If there's no view up in the way, if there's nothing else in the way, I will take profits at the imbalance because I know price is a good chance it might reverse at the imbalance. And also always watch out for volumes. I can tell we broke this imbalance right here. So most of the time when you see an imbalance being broken, it's because we had a surge in volume at the imbalance. So when you see a lot of volume at an imbalance, the imbalance will then break, right? As a good example right here, all the time, right? 600, and we push into a buy sign imbalance with 1200 volume doubles, right? Good negative selling pressure increases as well, and we break the imbalance. So if we're approaching the imbalance with increasing volume and increasing selling pressure, if it's on the way down, or buying pressure on the way up, a good chance the imbalance will actually be broken. And how I play them, man, is a lot of different ways I used to play these. Again, you can use it on the book map, use it on the footprint chart, whatever you want to do, but you wait for an imbalance level to be formed in supply and or demand. And if it aligns with my overall market plan, it can present me an entry. That's how I use these imbalances, right? Also, as take profit for positions and to confirm my bias. So I know I want to go short off supply because it's part of my pre-market plan, and there's an imbalance. I can then now use these imbalances as an entry, right? And put my stop loss right above the imbalance and put my take profit at the next coming imbalance. So I will use them as an entry. Also, another very important thing is the tape level. So these levels align with my zones again and buy, so I can use it for an entry. So for this example, we needed to see big buyers present at the imbalance or the market would not hold. So This right here in supply, we came back in, we tested supply where we had massive sell imbalances, and we did not see a lot of volume, right? Until the volume died off, so the move down started to happen. So it confirms my bias, it confirms the strength, and it does a lot of different things. So something big we have to pay attention to in imbalances is there's two different types of imbalances, right? We have continuation imbalances. So for a move up, we'll see an imbalance and the move will continue, right? For a move down, we'll see a red imbalance and the move down will continue. But we also have reversal imbalances. Now, reversal imbalances will look a little bit something like, had a great example here, like this. So it will be a green imbalance at the very top of a candle or a red imbalance at the very bottom of a candle that we don't see a single bid beneath. These imbalances are showing you kind of significant absorption, basically. So whenever you see these imbalances, right, on the opposite side, they're actually a great indication for reversal. But we're going to talk about more of these imbalances in the later on sections when we're actually. I hope you guys enjoyed the video. So if you want to learn a little bit more about footprint charts, about imbalances, I'll link a free course down below in the description. Basically, it goes a lot more depth about footprint charts, imbalances, bookmap, level 2 data, all the such. But if you guys are ready to level up your game a little bit more and get some either one-on-one lessons with me or go live and trade with me every single day, so you see what we're doing live in action, I'll leave an application down below for our one-on-one mentorship and also our live trading mentorship. Basically kind of takes the guesswork out of trading so you can see what you're learning here being implemented in real time. Now, we don't have this open all the time. We just reopened for October. We had some students actually graduate here recently. So a shout out to one of our students who just ended up actually starting to go crazy, man. I'm Y2K Ray here took over on $20,000 in payouts last month. One of our big students who has been going completely in, joined our mentorship about a year ago and is now taking tens of thousands of dollars a month when it comes to trading prop firms, which is absolutely awesome. And a couple of other students that were doing really, really good, man. I love coming out here and just showing you guys what is possible, what these students are doing, man. Again, a beautiful, beautiful day. Everybody's eating, super, super happy, man. This guy actually just joined the mentorship student like 1 or 2 weeks ago and kind of see the big difference that it's actually currently making, guys. But without further ado, one more thing I want to show you from a new student who actually just joined in the mentorship. Again, these people are watching us trade live almost every single day, and honestly, they're doing super, super, super well, man. For example, here, his second full week in the mentorship, already seeing massive, massive results with keeping the losses small, right? But the winners big. That's what it's all about. We teach the one and done setup where we only want us to take one trade a day and done, right? To become traders, you're interested in it because of the freedom, and the money is a good plus, but the freedom is what puts you in this position. Because you don't want to sit in the front of the screen and trade from 9 to 5, 8 hours a day. If you're going to do that, just go ahead and get a real job. The one and done system is what we teach and what we want our students to learn. One trade a day will keep the 9 to 5 away, guys. Please like and subscribe, and I'll catch you in the next video.